Stop losing money. Here are top investing mistakes that you need to avoid. Hey, I'm Charlene. I help people master their money and energy. From working in banking with the world's wealthiest for over 7 years, here are common investment mistakes that could save you thousands. Whether you're new to investing or you've been doing it for a while, avoiding these common mistakes can help you grow your wealth, your assets over time. All right, let's go. Mistake number 1 is trying to time the market. Many people think they can buy at the perfect time and sell at the perfect time, but in reality, no one knows what's going on. Like even the professionals don't know. People and professionals can have opinions of what they think will happen, but no one knows for sure. So instead of focusing on when to buy and sell, my view is it's better to stay invested for the long term. Remember, it's not about timing the market, it's about time in the market. For long-term investing anyway, day traders can look away. Also, when timing the market, there's so much time and energy that you can spend in research, analysis, all of that to try to find these little times, when to buy, when to sell. Personally, I don't think a best time exists, except when it's in hindsight. So in my view, it's easy to look back at a graph and say, if I just bought at this point here, or if I sold at, this point up here, then I should have done that. And that's great in hindsight. But when trying to make these decisions and in my view, guesses in the moment, in the present, that can just take up a lot of energy and time. Whereas you could redirect that energy to something else, something that maybe lights you up, whether it's a passion, a project, a business, or even spending time with your families. So my view, stop trying to time the market, just stay invested, invest consistently, and enjoy compounding. Mistake number 2 is letting emotions drive investing. Okay, so let's talk about emotions. Ever felt like selling everything when the market dips, or felt FOMO when a stock is surging? That's emotional trading, and it can seriously hurt your returns. In behavioral finance, there is a concept called loss aversion, where people feel the pain of losing money more than they enjoy the pleasure of making it. So effectively, losses loom larger than gains. So take a breath, get grounded, your energy matters here. Instead of reacting to what's happening in the market, all the volatility that we see, stick to your plan, stay consistent, and stay calm. And also recognize that our emotions play a part. So when you're checking your investing portfolio and you see, okay, that the market's down say 6% or whatever it is, then you might get an emotional reaction. Similarly, when your portfolio is doing well, you might feel like a rush of excitement or joy or something like that. So be aware of how your emotions are influencing your behaviors when it comes to investing. Mistake number 3 is ignoring fees when making investments. So when you're investing on an investment platform, these platforms charge fees, like annual fees maybe per trade, and different stocks or funds or different holdings can charge different fees. So make sure you're aware what you're being charged. Okay, I'll give you a little example here. So one of my friends was invested in a number of funds, all charging different fees. Now, when she looked at what stocks were held in all of these different funds, they were actually broadly the same, like mainly a bunch of tech companies. So she was basically paying different levels of fees for the same stuff. So some funds were charging her X amount, and then some were charging her more for holding the exact same stuff. So she was basically paying higher fees for holding the same stuff in some of the funds. Now, if she didn't check the fees, she wouldn't have realized that and would have continued in that same way. So when you're investing, check the fees that you're paying. Mistake number 4 is checking your investments daily. Look, I get it. When you're invested, it's tempting to just check your portfolio every single day. You can just quickly look at your app. But if you're a long-term buy and hold investor, it's pretty much wasting your time. I review my portfolios once a month, and that's it. Daily checking is just going to give someone anxiety, and that's not good for anyone. If you invest regularly, like every time you get paid, why not try automating that investment payment so you don't have to log in and manually buy the same thing each time? That's what I did. Mistake number 5 is expecting quick results. Everyone's chasing the quick wins, the quick cash, but long-term investing isn't a get-rich-quick scheme. It's more like planting a seed. You give it time to grow. People often expect instant returns and get disappointed pretty quickly when the £1,000 they invested didn't grow by X amount in a week. Remember, wealth building is a long-term game and patience is key. So remember, when investing, keep your emotions in check, don't ignore fees, and be patient both with your money and your energy. So those are 5 common investing mistakes. What's the biggest investing mistake that you've made or avoided? Let me know in the comments. If you found this video helpful, hit the like button, bell button, and subscribe for more on how you can master your money and energy. See you in the next one, guys. Bye!